All right. Good afternoon, everybody, and welcome to our webinar this afternoon, State and Local Tax Checkup. Your presenters today are Karen Poist and Kimberly Tarnakow. Just a few housekeeping items before I move on and pass it off to them this afternoon. A few stand on us by the numbers stats here for you. We do have 60 plus years dedicated to serving that AE space. We have team members in 15 plus states. I believe that's creeping up on 25 now. And we do serve 1,000 plus clients in all 50 states. So we are throughout the entire United States. And we are a top 60 value-added reseller in the US for our selling of the Deltek platforms. So a few GoToWebinar housekeeping items today after we meet our presenters, of course. We have Karen Poist. She's the managing director of our state and local tax group here, and she works hand in hand with Kimberly, a director in our state and local tax group. And you'll be in good hands this afternoon. So a few housekeeping items. You can customize what you're seeing on the screen by using the drop-down arrows on the GoToWebinar screen viewer. The slide deck that Karen and Kim will be walking through today will be available for download in the handout section of the GoToWebinar panel. So make sure you go out there and snag that. If you need the one CPE today that we are offering, please complete all 3 polling questions throughout the presentation and complete the survey at the end of the presentation indicating that you do need that credit, as that is how we pull your information to send you those certificates. And especially take that survey at the end to let us know how we did. Any questions that were not answered during the presentation, drop those in there and let us know any future topics that you would like to hear related to our state and local tax issues that you will hear from Karen and Kim today. So unfortunately, hopefully not. Hopefully you don't experience any audio issues, but if you do, you can toggle back and forth between the computer audio and the phone option today. We do find the phone call option is a little bit more reliable as it is not streamed over internet. And unfortunately, we did get a message from GoToWebinar right prior to this webinar that we may not have the recording of this after the presentation. So here's your chance to forward the registration link to all your colleagues that may also be interested in this, just in case we don't get a copy of that recording. So without further ado, I'll pass it off to Karen and Kim.
Thank you so much, Kaylee, and good afternoon, everyone. Thanks for joining us today on another wonderful state and local tax webinar. I know it's always exciting stuff when we're talking about state and local taxes, but just a couple items. We're just going to go through the agenda real quick, and then we'll jump into all our material. As we mentioned, the registration links, we're going to be talking about state registrations, e-filing returns, and electronic payments. We're going to touch again on remote employees. That's a topic that never goes away, and we can always add some additional information regarding remote employees. We're going to touch a little bit on service sales and state sourcing, and then also identifying the states that you need to be filing in, as well as state planning considerations. And then to wrap things up, we are going to be talking about that Build Back Better Act and legislation that's currently out there and pending. So with further ado, we're going to move on, but I thought we'd kick this off with something that we found kind of interesting. Of course, we always talk about the states, so we thought we'd put a map of the states, and because of the holiday season, we thought it would be really neat to show all the most popular Christmas songs by state that are out there. One of the things that grabbed my attention was that state of Ohio. I don't know what's happening in that state, but you know their favorite song seems to be "You're a Mean One, Mr. Grinch." So not sure what's happening in that wonderful state of Ohio, but apparently they're the only state that really truly enjoys that song title. So anyway, moving forth, we'll start in with our state registration. Okay, so one of the things we always look at is, you know, my company has nexus or a connection in a specific state. So now what? What am I supposed to do? Well, you know, you may call and say, hey, I'm registered for my payroll taxes there, or I'm registered for income. But there's also another state registration. There's technically 2 state registrations that need to be had when you have a connection with a state. And one is the authority to transact business or qualify to do business in a state. And the second one is your tax registrations related to payroll, you know, income tax, etc. So the first one, the authority to transact or qualify to do business in the state, is really the legal side of things, okay? That's to make sure that you are operating in the state legally. And these registrations are generally done with the Secretary of State or the state commissioner of that specific state. Generally, there's some registration fees. You'll get state ID numbers. And if you do not register in these states, from the legal standpoint, as you can see here, North Carolina, the courthouse doors are said to be closed. So if you have any type of issue that you may have a customer in that state that you're working with a contract on, something goes awry, you know, the jurisdiction is that state, and you go to, you know, put forth some motion, and they say, well, we don't have you in our state. You know, you're not even supposed to be here. We didn't even know you existed in our state. Therefore, we do not have to afford you access to our legal system. So this is a very important registration that if you are working in a specific state or you have an employee in a specific state, it's also to protect that employee. God forbid your employee gets hit by a car delivering mail for the company. You want to make sure that you have some type of recourse or action that you can take to rectify anything that may go wrong. As you can see here, if you do not get the authority to transact business in a state or qualify, there are significant penalties that can occur. As you can see here, we indicated the most extreme, which is the state of Alaska. They will charge you up to $10,000 per year for operating in their state without authority. So again, every state does impose a penalty. The amounts vary by state, well, except for one state, which I found very fascinating, is the state of Pennsylvania will not penalize you or charge you a fee for operating in their state without qualifying to do business. I found that very interesting. But also, the authority to transact or qualify to do business is generally not done by a CPA. I know a lot of business owners would love their CPA to do this kind of work for them. But generally, these are done by a legal, you know, manner, whether it's through an attorney or through service providers that specifically provide that service. And what it does is they put you in that state from a legal standpoint, meaning that the state requires that you have someone that is registered within that state or a contact that is located in the state for any type of accessibility for any type of matters. Also, this may require some annual reports or minimum yearly fees to make sure that you stay in good standing with the state. Again, this is very different and totally different from the tax registration. So be aware this is one type of registration that needs to be done in addition to the tax registration. So very little on the state tax registrations. Generally, you can do these on the same application based on what's applicable to your company and what you're doing in the state. You would register for your corresponding taxes. A lot of these now are online. Some have fees, some don't have fees. Some will require a designated officer and employee to sign off on that application. It'll also give you the determinations for required filings, frequency, whether it's payroll, sales tax, income tax, etc. And as you see in the next section of this presentation, it's very imperative that you do get that assignment of a state ID number, as Kim is going to talk us through the next section in regards to having the capacity to electronically file business returns and also pay. So Kim, I'm going to take that over to you now.
Thanks, Karen. So we're going to talk about e-filing of returns and electronic payments. And we are seeing more and more every year that states are requiring returns to be e-filed, both business returns and individuals. And honestly, as a tax preparer, I don't hate this. It's just easier all around. You know, we don't have to print returns and mail them to clients who then have to go to the post office to mail them. The state doesn't have to hire somebody to open all the envelopes and scan them and get them into the system. It's just much more efficient this way. But again, they're turning into requirements, not options. And as Karen talked about, a lot of times you'll get several different ID numbers when you register, when you go through the registration process. You may get a Secretary of State ID, which is different from all your tax IDs. And many times, in order to qualify a return for e-filing, on our end as a tax preparer, we have to have those correct ID numbers. in the software, or it won't qualify and it won't e-file. Now, sometimes if you have an incorrect number, which is why it's very important to keep good tabs on what your numbers are, keep a very good list, it may go through, but then 6 months later, you'll get a notice, hey, you didn't file this return. And we start scratching our head because this has happened. Well, we did file a return. We're not sure why you didn't get it. And here's your e-file confirmation number. And they'll say, well, you didn't use the correct number. So therefore, the return isn't considered filed. So that's one of the things you got to be aware of. And if you don't e-file when it's required, there can be significant interest and penalties. And for New Jersey, for several of the states like New Jersey, if you have a paper return that you file because for some reason you can't get it to e-file or for whatever reason, the state may receive it, but they'll deem it not filed. And so you'll be hit still with all that interest and penalties. And then finally, it can result in forfeiture of a state registration. If your return is not applied to your account correctly or it's deemed not filed, it can cause the forfeiture of your state registration, which means you have got to go through the process of getting that reinstated, which can be costly, maybe not costly, but it still takes time. It's just a hassle. So these numbers are very important.
Yeah, and as Kim mentioned, we've seen a number of these with the state of Texas. They have different ID numbers, and if you don't have that right ID number on that Texas return that you're filing, as Kim mentioned, it'll go through. But again, you will get a notice in the mail maybe 6 months to a year later that says, this is a notice of intent to forfeit your right to transact business in our state. And again, you're left like, I know we filed this, I signed the return, etc. But what happened was it went through, but it didn't get processed. So the state system doesn't show anything being filed. And so it's really imperative that, as we talked earlier, is that we get these state registrations done, because these state registrations, whether on the legal side of things or also on the tax side of things, they're imperative in order for business owners to be filing going forward and be compliant with their taxes. So that's just a note to be aware of. And again, as Kim mentioned on New Jersey, that's a nasty one. They will not even accept a paper return. They will accept your money and cash it, but they'll put it over in a holding account. They just don't know what account to apply it to. But the thing is, again, it's a nasty situation, but you can rectify this by definitely making sure that you're registered on both aspects, either legally or through and your tax registration.
Well, and hand in hand with the e-filing requirement, we're seeing the requirement for electronic payments. And I can't emphasize enough how important this is. Many states are requiring payments to be made electronically. They're no longer accepting non-electronic payments. And the states may have specific methods of payments. For example, you may have to have an auto withdrawal. You may be able to go in and just pay with a credit card. You may have to go through the Department of Taxation website, or they may use a third-party provider for this. But it's something that that you need to be aware of. The other thing is that the electronic mandate for payment can be based on several different things, like a tax threshold. If your tax is a certain level, either a particular payment or your liability for the year, or if you have any tax liability at all, you're required to pay online. And we're seeing more and more of that. We are strongly encouraging everyone to go ahead and set up for every state that you can pay electronically. This may take some time. Sometimes you can do it immediately, pay immediately. Other times it may take several weeks to get it set up with the state. So we encourage you to do it now so that you're all set up for the filing season. The other thing that we just want to say why we really support the electronic payments is we have seen so many payments that were made cash through the mail this year, not cash, checks through the mail this year, where either the payments weren't posted, they weren't posted correctly, especially the IRS didn't get the envelopes opened. It creates a huge problem where if you file electronically or pay electronically, you have a good trail, you have a confirmation number, and it's on the state to figure out where they put your money. So this is something we are strongly encouraging everybody to do now.
Yeah, and Kim, just to add to that, I just wanted to mention that, in order to be able to go ahead and pay online or pay through a state-specific website, you are going to need those registration numbers that I talked about earlier. So I just want to keep that in the back of your mind that, again, you're not going to be able to pay electronically unless you have an account set up with the state. And generally, that's either going to include one or both of those registrations that I mentioned earlier. So if you're not registered legally in the state, I would suggest to do so if you're currently filing. And then also if making electronic payments, making sure you have your tax registration account set up. So anyway, with that, we're going to move on. And Kim, you can mention some of these examples of states.
Well, and here just for business returns, a few of the examples where you may be required to make electronic payments. For Alabama, there's a single payment over $750. It's got to be electronic. For Arizona, if your total tax liability is over $500, it's got to be electronic. So Connecticut, New Jersey, New York, Ohio, all these payments have to be made electronically, no matter what the liability is. Pennsylvania, if it's over $1,000, the Washington B&O needs to be paid online. So again, we really encourage everyone to go ahead and get your numbers listed on, get them in a spreadsheet, get them where you know where they are all together, because your tax preparer is going to need them. You're going to need them to make payments, but it's hard when if they send you something in the mail or an email and you lose the number or you can't put your hands on it right when you need it. So, make a good list so that you have all those together.
Yeah, thanks, Kim. And again, the states are going to make it much more difficult for you to file and pay if you're not doing it electronically or you're not doing and you don't have your registration numbers. So it's real important to visit that or, do a checkup on where you are right now and what you have. So with that, we're going to go to the first polling question. And Kaylee, can you take that for us?
I sure can. So I'm going to go ahead and launch the poll. And the question is your company qualified to do business in the states in which you are currently filing state income tax returns? You have 4 options here. Yes, no, I have no clue, and I thought we were. So I'm going to keep this poll open until either 60 seconds elapses or we get 85% participation. And here's your first of 3 reminders that we need you to answer 3 polling questions in order to receive that CPE. And we have about 84% voted, just need a few more clicks here, and then I will go ahead and close and share the results with everybody. All righty. So I'm closing the poll and sharing the results with everybody. And 90%, wow, said yes. 1% said no, 2% say they have no clue, and 6% say they thought they were.
Well, that's a great response. I'm so glad that 90% of the people have definitely qualified to do business in the state, and that's refreshing to know. So that's fantastic. So with that, we're going to move on to our next section. And Kim, if you want to take it off with our remote employees.
Sure. Remote employees, a topic that is very near and dear to our hearts, as Karen and I are both remote employees, and a lot of you are, I'm sure. Most companies have gone to a remote workforce in some form or fashion over the last year and a half. So why does that matter? Why do we care? Because we've talked about it in every webinar this year, so clearly it is important. Well, we've talked about Nexus, the connection with the state that allows them to levy tax on you and require you to file returns. Well, there are 3 types of income tax nexus. There's a physical presence where you have a body or property in a state. There's economic nexus where you are trying to develop a market in the state, or there's a factor presence thresholds where the state has said, if you have a certain dollar amount of either property, payroll, or sales, you're deemed in the state. So clearly, if you've got a remote employee, you need to consider this because you've met the physical presence threshold. Also, if you have an employee traveling to state, let's say to do a trade show, to visit a client or a customer, if they're in the state for a certain period of time, that can create a filing requirement or nexus for your company. So the tax consequences for having a nexus can be different depending on the various state. The rules vary by state, which is basically our standard answer for everything because every state is different. So you just need to Be aware of where your employees are working. Track them, how many days they're in a state. For those who are going in just for a short period of time, keep track of how long they're there, because you need to know this. This can create income tax exposure. It can create payroll exposure, sales tax exposure. You just need to be aware. So if you're new, you have a new state that you're in, what about filing and payment? What about all this stuff? Now what do I do? Well, once your business satisfies the nexus requirements, you may have a filing requirement and paying and all that. So you need to consider not just income tax, but again, franchise tax, gross receipts tax, sales and use tax, personal property, business license, payroll taxes. And Karen and I have been doing several studies to help clients figure out, hey, what does having a remote employee in a state look like? What is this doing for me? How much is it costing my company to have a remote employee, one remote employee in a state? And one thing that we've noticed that the rules are different. And a lot of the local, the city and the county level rules haven't caught up with the way we're doing business now. You know, many of them require you to have a business license if you have a remote employee in the state, but a lot don't. But I really think that they're going to catch up. They all need money. And I think they're going to start updating their rules to account for this and to start being able to charge companies to have employees in the state, because they are in the state. The other thing that's interesting that we found is there's like a home occupancy permit that sometimes a few jurisdictions require. If you've got somebody working from their home, they may be required to have a home occupancy permit, even if they have no one coming to their home, clients, if they just are sitting there working. So it's been very interesting, just something to be aware of. And also, with the COVID-19 emergency orders, there's many levels to this and facets. Some of them have to do with like the mask mandate, the physical societal things. There's also things that have suspended the like the nexus standards or the payroll withholding requirements. Many of these have expired or they're getting ready to expire. So just be aware, once they expire, we're going back to the pre-COVID standards. So where you may have been given a reprieve from filing income tax returns in a state because of nexus, or payroll withholding because of an employee in a state, you may now have to do that. So just be aware those are expiring.
Yeah, and just to summarize everything, and really the point of this, and going back to the remote employee topic, is, you know, we're coming up on year end, and one of the things that is really imperative for, you know, your filing requirements and what states you'll be filing in for the 2021 season, for the 2021 tax returns, is making sure that if you did have a remote employee in the tax year 2021, make sure you let your tax advisor know that, yes, you know, we weren't just working in, say, the state of California with employees. We hired two other folks. One's in, you know, Florida and one's in Colorado. You know, make sure you're, you know, giving that information to your tax advisors, so then they can also assist you in looking at the recommendations and the requirements for filing and making sure you're staying compliant in these other states. So anything else on that, Kim, or we'll move on to our next topic?
I think we're ready to move on.
Okay, wonderful. Okay, so I know this is another kind of, we don't want to be technical in this thing, but service sales and state sourcing. We're just going to talk about services. So, you know, some of the questions come to mind when we look at this. And the first one is, in which states are your company services being taxed? And then, are you sourcing your sales to the right states? And if you can't answer those questions, you know, could you be overpaying your taxes in a specific state? And I think these are very important things, and these can also drive your liability for state tax purposes. So there's really two methods that states are using currently to source revenue sales from services. And this is just services. So if you're selling products, this does not apply to you. If you're selling services, this applies to you. So the most common is the market-based sourcing, and generally your services, your sales revenue is sourced to the state where your customer derives the benefit of your service, or the customer location, wherever they're deriving the benefit of your service. The other method is cost of performance, and that's where your sales are sourced based on where you do the work. not necessarily where your customer is, it's where you're doing the work. A majority of the states are market-based sourcing, as I mentioned, but there still are a handful of states out there that are under the cost of performance method. And as I go through this next example, you're going to see how this kind of impacts your state taxes and your potentially your liabilities. And I laid out here, Company A is located in California, so they have nexus or a connection with the state of California. They have a remote employee in the state of Idaho. Okay, so now they're also have a connection with the state of Idaho. So now they're both in California and Idaho. Customers located in California, where the company is located. California, as indicated here, is a market-based sourcing state. Idaho is a cost of performance state. The remote employee in Idaho is performing all the work on for the California customer. Okay, so in this example, where's our sales source in this case? Okay. Well, if you look at California is a market-based source state. We're in the state, that's where our company's located, and they're going to say that, well, our customer's here, the customer's deriving the benefits. So California's going to say the sale is here in our state, the state of California. Okay. Well, then you talk to Idaho, and Idaho is like, well, no, all that work that's being done for your customer in California is done in our state. So that's our sale. So guess what? Now the sale is sourced twice, once to California and once to Idaho. And therefore, that sale is included in both states as sales revenue and then taxed accordingly through apportionment or whatever. So you can have that option. You can have the exact opposite, where the sale is sourced nowhere. So if we reverse the scenario here, Idaho would say, well, no, our customer's not here. We're doing all the work in California. California's like, well, no, our customer's not here. It's in Idaho, so it's not our sale. And Idaho can say, customer's here, but all our work is in California. It's not our sale either. So you can end up with a nowhere sale. You could be taxed on the sale by two different states, okay? And this is the problem when we have two different sourcing methods. So the takeaway on this is make sure that you're looking at your sourcing of service revenue and what that looks like. And especially now if you have remote employees, and wherever those remote employees are and how they're working, and if they're a cost of performance state or if they're in a market-based sourcing state, and making sure that now you're servicing service sales and how you're sourcing that revenue can change. So that's just something to be aware of and just to be on the lookout for as you come to year end. Revisit those rules, revisit where your remote employees are, and then make adjustments or changes accordingly. So Kim, I'm going to let you go ahead and talk about how do we identify where we should be filing.
Well, we've thrown a lot of information at everybody, Karen, looking at the sourcing of our sales and remote employees and just the state registration. So now what? What do we do with all this information? Well, if you're new to a state in 2021, for example, if you have an employee working in a state in which you've never had a customer, you've never had, so no sales, you haven't had any type of physical presence there before, what happens? What do I do? What's the first step? Well, the first step is to determine if you legally have nexus in the state and a filing requirement. If the connection there great enough that's going to cause a filing requirement. If so, then you're going to go through the steps to source your revenue, as Karen mentioned. Find out if that new state is a cost of performance state or a market-based sourcing state, and then source the revenue accordingly. Next, go through the process of doing all your legal and tax registrations and get all your SOS numbers and your Department of Revenue ID numbers so that you have all that lined up and ready to go. And then you can go ahead and do your income tax or gross receipts tax filings. But then don't forget about the other state tax considerations. Look at sales tax. Because I'm in a state, do I have some type of a sales tax requirement? Even if I'm not selling tangible property, there are certain states that tax services. So be aware, look at those rules. Consider ad valorem filings. there's a pocket of states like Ohio, Pennsylvania, New York, sort of in a row that don't have personal property return filings, but most of the other states do have a personal property return filing. And so you'll have personal property tax. Check those rules. Check the date that the returns are due, the date you look at the property. Consider the business license filing requirements. Look at the jurisdictions, the local jurisdictions. Just look at everything globally to figure out what all may come into play, because you may have nailed down the state income tax piece, but that's really just the first level. There's a lot more things to look at. So that's if you're new to a state. Well, what happens if you're not new to a state in 2021, but let's say you've been there for 10 years, but you haven't registered to do business, you haven't filed an income tax return. Well, now what do? Do we just go ahead and start registering and filing? No. We do not recommend registering or starting to file at this time, because that can lead to what the states refer to as discovery. And once you are discovered, the states can go back and charge you for any delinquent income tax, sales tax, for interest and penalties clear back to the first day you have nexus in the state. That can be very costly. So we recommend just hold on. Let's quantify our exposure. Let's figure out what the exposure is. Let's start with income tax and then move on. Is there exposure in sales tax? Is there exposure in payroll taxes? Because there are opportunities to mitigate these damages. We can limit the look back period, maybe to 3 or 4 years, and get the penalties waived. But normally when you go through these mitigation processes, you have to come clean and clean up all your taxes. They want to do it all so you're good to go. So once you address that and you figure out where you would like to start filing, where you need to file, you get compliant with all your back taxes, you get all cleaned up with the state, so you and the state are all good, and then you can start filing on a go-forward basis. But again, we never recommend just start filing if you have prior year exposure, because it can be very costly.
Yeah, and just to add to that, Ken, you just want to make sure that you have a game plan. If you discover going through this year-end process before jumping into filing your 2021 taxes, again, if you're new to the state, great, jump right on that, get yourself registered, get that moving, and make sure you file in 2021. Therefore, you're ahead of the game, you're not behind. If you're not new to a state in 2021, and as Kim mentioned, you have prior year returns that you should have been filing, it's a good opportunity to identify that and maybe come up with a game plan to address that. Maybe not so much during the first few months of the year, but maybe in a spring or as a project that you can take a bigger look at this. And I would recommend getting the full picture. A lot of people say, hey, we're good, we only have income tax, we have no sales tax. And again, services may be taxable in some states for sales tax purposes and maybe not in others. So when you're looking at this, you may think you don't have a sales tax issue, but you potentially could until you start looking at that state's rules and actually what you're doing there. And it's good to get that game plan out there and look at that big picture before taking a step forward. And again, as Kim mentioned, if you do register, undoubtedly once you register or you just start filing a return, say in 2020, you say, hey, I'm just going to start filing in California because we're in California now. Well, did you consider the prior tax years? And I can assure you, California's been pretty aggressive. They're going to come back and ask for prior tax returns, and then you're going to have to file. The penalties with the state of California are extremely significant. And again, with a mitigation opportunity that could be had, it's a good way to not be subject to those penalties. So just as a word of caution, definitely, if you're new to a state, proceed as normal. Not new to a state, you definitely have a lot of things to consider before going in and starting to file or register with that state.
And Karen, a lot of times what we see is if you just start filing a tax return out of the blue, especially if you haven't gone through the registration process and all that, you immediately get a Nexus questionnaire from the state. And one of the first questions on that is, what is the first day you started doing business in this state? And obviously you don't want to lie because you're signing stuff under penalty of perjury. So you have to be honest. And then that can lead to, okay, discovery. And guess what? You owe a lot of interest and penalties and back taxes. So like Karen said, think through it. It takes a well thought out plan to minimize the damage that can be here.
Yeah. And again, this is something you should always be talking with your tax advisor, whether during the course of the year or at the end of the year. You know, I know everybody's concerned about federal tax matters, but state tax matters can be just as, you know, damaging in regards to liabilities or unwarranted liabilities or unknown liabilities. And this is something that you definitely need to address, I think, at the end of the year, or again, as I mentioned, throughout the course of the year, to be certain you're on track. And then if you're not on track, you know, again, get a game plan together and move forward to get compliant. So with that, we're going to go into our next polling question. And Kaylee, can you take this one?
Absolutely. So I am launching the poll now. The question is your business sourcing service revenue correctly under the MBS and COP methods? So you have 4 answers here. Yes, no, what is MBS and COP? And it's too much work. So same thing as the last poll. I'll keep it open for either 60 seconds or until we have 85% participation. And then I will go ahead and close and share the results with everybody. Alrighty, it looks like we're almost at 80%. Just need a few more participants here in our poll in order to move on. Alrighty, we're at 81%. All right, closing and sharing the results for everybody to see. 61% say yes, 7% say no, 30% say what is MBS and COP, and 3% say it's too much work.
Yeah, this is a nuisance by, you know, the state to business owners, you know, to trying to have to keep up with a varying sourcing method of the service revenue. And it is, I'm in agreement with everybody else. You know, this is a lot, and it's a major effort to go through this process. But again, you know, it is kind of important because, you know, you don't want to be sourcing revenue to a state such as California with a really high tax rate, where it could be, you know, going to a different state with, you know, a 5% rate versus, you know, maybe a 12% rate. So, you know, it is important, and you know, that's something to take under consideration when you're looking at this at the end of the year. So with that, we're going to move on to some state planning considerations. And again, you know, we're going to start off here with, you know, the federal and state conformity. Obviously, you know, the federal passes laws, and then the state decides whether or not they're going to follow those. So we're always having differences when we're filing these business returns, or when you're doing a business return. You know, you may have an NOL for federal purposes, and you have rules on when you can deduct that NOL, and then you have different rules for the state. Same thing with, you know, the biggest and most common one is the bonus depreciation. So as you work through the end of the year and you're doing planning with your tax advisors and things like that, is definitely make sure that you're considering these Fed-state differences in regards to the TCJA and the CARES Act. And unfortunately, there's a lot of states that are out there that still haven't decided what they're going to do, whether they're going to follow federal law or they're going to do something on their own. So again, all states are different. You definitely need to visit that based on the states that you are filing in for the current tax year, and make sure that you don't make that hiccup with thinking that you have an NOL for federal purposes and you're also going to be able to take that NOL for state purposes. Or you have that $500,000 bonus depreciation deduction on your federal return and you get zero bonus on your state return. As you can see, it swings that taxable income subject to tax in that state quite drastically. So definitely keep that in mind as you move through the planning process with tax advisors, and keep that into consideration. Another item is the ever known Paycheck Protection Program or PPP loans. As we saw in 2020, a lot of folks did get their loans forgiven in that tax year. Some loans will be forgiven in the 2021 tax year. But again, the state rules don't always follow federal law once again. And here we've laid out some right now. And this is up to date as of September 2nd. There hasn't been any changes to this. As you can see, there's a handful of states that they still have not given any guidance under state law as to taxability of forgiven loans or deductibility of expenses for forgiven loans. But just as a word of caution, again, if you did have a loan forgiven in 2021, generally you're not going to have that impact on your federal return. It's not going to be taxable, and you're going to be able to take all those deductions attributable to that loan. But when it comes to the state side of things, if you had like a $4 million PPP loan that got forgiven, okay, that's great on the federal side, but how does that look like in the state of California? Is the state of California going to allow me to take all those deductions related to that? Well, if there's limitations on those, I may be adding back $4 million worth of deductions to my California source or taxable income. And that's a heavy hit on the state side of things. So, again, a word of caution, be prepared when you're looking at some of these things at year end, thinking that, not worried about that PPP loan forgiven, we're not going to have anything. But guess what? You may on the state side of things, and you don't want that unwanted surprise or that unwanted liability or unknown liability that you weren't expecting. So keep that in mind as you plow through planning. Again, if your company had received any state or local COVID grants, again, look at those. Some may be taxable, some may not be, and make sure you take a look at those and make sure you're treating those properly for state purposes. Again, they may not be taxable on your federal return, but again, look at your state side of things. And Kim, I don't know if you had anything to mention on some of those items that I just mentioned before I jump into the pass-through entity tax elections.
I would just say what we saw last year was a lot of times the PPP proceeds were not, they were buried or in other revenue or whatever. So I would encourage you, if you had any PPP forgiveness, to make it very clear to your tax advisor exactly what it was, when you got it, and all that, because sometimes, it's hard for us to find stuff in your number. So just make sure that, again, as you're telling people, your tax advisor, hey, I've got a new remote employee in this state, mention, I had a COVID grant, because that may save you some money. I had PPP forgiveness. We just need to know all those things that may stand out for state purposes.
Yeah, and it's really just to make sure as a business owner that you understand or are aware of the varying rules between the federal and state things, especially if you're looking at this from a cash flow standpoint or any other standpoint in regards to taxation, is understanding those little nuances between the federal and state matters. So with that, I'm going to move into this pass-through entity tax. And again, I know it's always in the news, and if you hadn't heard about what's happening with this SALT cap or the state and local tax deduction limitation, you're probably very fortunate. But it's in the face of many all the time, every day, every evening on the news, every article you read, it's out there as to what's going to happen with this. I guess I don't know what you call kind of issue, but anyway, what the states have done is the states have developed a workaround so that you can get benefit from a deduction where you're limited on the individual return on your state taxes. So the states did develop this state tax workaround, and what that does, it has, instead of the income from a pass-through entity flowing through to your individual or to the various members, that the state is allowing you to have that income taxed at the entity level and get the deduction at the entity level versus the individual level. Now, what's going to happen with the state and local tax deduction, who knows? Right now, it looks like what's on the Build Back Better agenda is that they're going to raise the cap and then eventually put the cap back in place starting in 2031, and raising the cap really to 80,000. Under TCJA, when it was originally put in place, the SALT cap was set to expire in 2025. And when we get to the Build Back Better slides later in the presentation, we're going to show you some interesting numbers in regards to the impact on government revenue generation from the SALT cap. Again, these can provide savings at the shareholder, the member level, depending upon many factors that are involved in this on the state side of things, and specifically the state in general that you're looking at. But as mentioned, this applies to pass-through entities as corporations, partnerships, LLCs. Again, the benefits may vary on a state-by-state basis, and every state does this workaround differently. So not all states do it exactly the same. So it's not going to be a benefit if you do it on one state. You're going to see the same benefit in another state or another state. Also, the benefits may be based on, some shareholders may have a great benefit, other shareholders may not. Also, the effective date. There are a multitude of states that have jumped on the bandwagon with the state workaround. A lot of these pass-through entity elections are effective as of 1/1/2021. But there's also a lot of them that do not go into effect until 1/1/2022. Now, also, a lot of states are saying that if the SALT cap is lifted or it expires, then this pass-through entity workaround by the state is no longer effective. It's no longer in place. It is removed. You cannot do it. So again, all states have different rules and regulations. They all have different effective dates. They all have different methods to elect to do the pass-through entity tax election. Some states have different forms. And you also need to be wary of the due date when the election needs to be made by in order to do this. It's not something that you can talk to your tax advisor on March 14th and say, hey, we want to do this. You may have already missed the deadline to make the election. Also, a lot of these elections are having to be made by a business owner, again, online through a state website, which you would not be able to have if you don't have your registrations in place. So just as a word of caution there, and as a reminder, friendly reminder, that a lot of these things, again, you may or may not be able to do, but you definitely need to be aware of it, know that it's out there. It may be beneficial to some shareholders and members, and this is something, again, to consider at year end. It may be beneficial, it may not be, but it is out there, and if it works for you, great. And lastly on this, I just want to mention that some of the tax rates may be different also. You may have a higher tax rate being taxed at the entity level versus if the income flows through at the individual level, so based on the state rate. So again, don't spend $1, to save 50 cents in federal taxes. And that's just a word of caution when you go through these analysis and look at these. It's not a one size fits all. It's definitely dependent upon the various facts and circumstances of each taxpayer and their current tax situation. So I'm going to move ahead, and right here's the map of all the states that have implemented the pass-through entity elections, and as you can see, there's quite a few of those. There's a few that are still in consideration that may or may come through by the end of the year. But just if you do or are operating in some of these states, this may be a conversation you may want to have with your tax advisor in regards to, is this beneficial for us, or should we pursue this or not? Really take a look at this. So, and Kim, do you have any other comments on that?
No, just, definitely talk to your tax advisor about this. The calculations to estimate if they would be helpful or beneficial or not are going to be pretty complicated. So, you're going to have to look at, hey, you probably don't want to look at a state where you have a 1% apportionment factor. The things to look at is what your net income is, what your apportionment is in the various states. There's several things that you should be considering when looking at this.
Yeah, and overall, before we move on to the next polling question and Build Back Better. I think it's one thing is Kim and I like to say is salt for thought. Always think about the state and local aspect. It's a big part of every company's bottom line these days, and making sure you're in compliant, whether it's with registrations or tax filings or any type of tax filings, or the sourcing of your revenue, or any types of advantages that states may offer that you can take advantage of for assisting in your tax liabilities is always good to consider. And just to make sure that you're aware of these and making sure that you're looking at these at the end of the year and making sure that you are in compliance. And one last thing on that is that, we see a lot of activity on the merger and acquisition scene. And with the merger and acquisition scene, we're also seeing a lot of due diligence work on the state and local side of things. And one of the things that you don't want to do is go to the bargaining table knowing that you have major state tax issues, or you're not in compliance on certain states. One, it could scare a potential seller or buyer away, in regards to, we don't want to deal with this mess. It can also reduce your selling price, and what you thought you're going to walk away with, you may not walk away with. So, anyway, just keep those things in mind. Always remember state and local taxes in your year-end planning. And with that, Kaylee, do you want to fire up the last polling question?
Sure can. It is launched, and so we have about 35% participation so far. So the question is, will your company be making any pass-through entity elections for the 2021 filing tax year? So you have a few different options here. Yes, no, I have no clue. What is a PTE election, and NA? So same as last time, we'll keep this open for a few more seconds here, or until we reach that threshold in order to move on for participation. And we're already at 83% here, so just need a few more people to participate in our poll, and then we can dive back into the last few minutes of the presentation here. Alrighty, going to go ahead and close and share the results with everybody. And 26% say yes, 32% say no, 26% say they have no clue, 1% say what is a PTE election, and 14% say it is non-applicable.
Yeah, I was going to say I figured this polling question, and Kim, I don't know your thoughts, but I thought this would be all over the board as well. I know it's very new for a lot of business owners, and very new for a lot of tax advisors as well. So this is going to be an interesting feat, I think, filing 2021 tax returns, and how many folks are going to benefit from this and take advantage of that pass-through entity election. So. Any further comments on that, Kim?
No, it's going to be an interesting filing season, as the last several have been.
Yes. Okay, well, that's going to bring us to the Build Back Better Act legislation and pending. And so what we have here is what we did. And, a lot of this may or may not apply to some of the participants on the webinar today. But I think the biggest one is the second one here. And I think when you see the revenue impact on these, and what we've listed here is a table. And of the table, it's the top 10 items that are going to produce the most revenue for the government, federal government, okay? And you can see on here, number 2, and this is a big contentious item right now, which is the application of the net investment income tax, that 3.8% tax on trade or business income of high-income individuals. And this is based on high-income individuals are considered, I think, is it 400,000 or more, Kim, is our understanding? So.
Yes.
Yes, and you're going to be hit with an additional 3.8% tax on that income coming through on active trade or business income. And as you can see, that's a big revenue impact for 2022 through 2031. So not certain where this is going to fall out. I know there's a lot of opposition to this, but I think this is the biggest one that may impact a lot of business owners and folks with a trade or business.
So Karen, just in case there's somebody who may not understand what this is, or if they don't have it on their return, they may not be used to dealing with it. But so the net investment income tax is a 3.8% surcharge on investment income, and this comes through, interest, dividends, all that stuff. But it also it can come from flow through income from partnerships, LLCs, S corps, if it's not an active trade or business for you. So if you're not actively in the trade or business, then you're getting hit with this already. But where we're really going to see the impact is if you have somebody this is their livelihood, they are in this business every single day, and in the past they have not been hit with this surcharge, they may potentially get hit with it going forward if this passes as it is written. And from everything we're reading, this piece is going to stick because it's a very easy piece to leave in there.
Yeah, and as you can see, it's got a huge revenue impact for the federal government. So this is something that's out there. We don't know where this is going to fall out or where it may lie, but this is something that we thought that is probably more, one of the more important aspects. As we move down that table, as you can see, the subtotal and other provisions and the total provisions, a couple other items here, the limitations, deduction for interest expense, that does some revenue generation, but not too much. But I think as you notice here, you don't see anything on that, ever common phrase SALT cap, right? That's not listed here. That's not one of the big 10 revenue money makers for the government right now. So why is it such a item of contention between so many people and so many things? And obviously it's probably buried in that other provision section there of 78.6 billion, which is the other. The top 10 bring in the 1.3 whatever billion, but you see the others is only tallying up to about 78.6. So we're going to take a look at that real quick right here. So this is billions of dollars, and this is to raise the state and local tax cap, deduction to 80,000. Okay, and that's they're going to raise it, from 2021 to 2030. Okay, and as you can see, it's a revenue loser, starting 2022 and 2023. So as they raise that cap to 80, you can see the lost revenue. Okay, now where it starts to flip around, as you can see, is 2025 to 2026. And as we discussed, that's when the SALT cap was to phase out. Okay, that's when we're going to go back to normal. We weren't going to have a limitation on the SALT cap. Okay, but they have extended it all the way through 2031. But you can see it eventually gets to positive revenue to 2031. But we found it very interesting. Even raising the cap to 80,000 is still a revenue loser. It's not going to generate revenue dollars. So we just found this very interesting and fascinating. Kim, I don't know if you want to add any commentary on this or not.
No, like you said, you hear that almost as much as the past Serenity election stuff, the SALT cap, SALT cap, SALT cap. It's all you hear in the news. So it is very interesting.
So, well, with that, we're going to move along, and we wanted to ask everybody in our last polling question, are you on the naughty list or the nice list? And we do have that list out there that you can check your name and see where you fall out, or you're, again, as Kim mentioned, you might be too scared to look. But here it is. It's put out by, the Secretary's Naughty or Nice list, the Minister for Christmas Affairs. So you can take a look at that. You can download that link. It might be something to share with your friends and family or coworkers, and just have a little bit of fun. And with that, I know I checked out all my family members and even my dogs, and we happen to be all on the nice list. So I was very excited about that. Now, I haven't checked out any coworkers yet, or any other folks, but you may not want to tell people if you're on the naughty list. But we thought this was kind of a fun thing to share with your friends and families or relatives around the holiday time, just to laugh and get a good kick. But with that, we just want to wish everyone happy holidays and have a wonderful new year. And please reach out to us if you have any questions, or we can be of service to you on any state and local tax matters or anything else that San Juan Ness has to offer with all their areas of expertise and specialty services. So with that, Kim, if you have anything else to say, have a wonderful afternoon. Be safe during the holidays, and we hope to visit with you again with another presentation in the new year.
Happy holidays.
Yeah, thank you all.